Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Thursday morning, pre-U.S. market opening, I was surprised to see this comment from a hedgie on Bloomberg's Markets Live blog. U.S. equities seem bored of the Iran story already. Admittedly, that struck us as a bit of a head-scratcher. Maybe it was just fatigue, as investors had been buffeted by, in addition to the impact of the Middle East, inflation, private credit, the Fed, and AI disruption. Maybe it's complacency, a foregone conclusion to just buy the dip. In any event, as if we needed a reminder, Thursday was just another day where the S&P 500 swung 100 points. Bored is not a word I would use. This week, our three things are: 1. Productivity boom or savings drain, peeling the onion on sources of growth. 2. Labor pessimism. Is the jobs picture really weak and fragile? And 3. Inflation pressure. It's building. All right, let's dig a bit deeper. Productivity boom or savings drain? It's a productivity boom. Q4 non-farm productivity jumped 2.8% annualized, easily topping the consensus estimate of 1.9% and adding fuel to the AI is here fire. The jump follows Q3's surge of 5.2%, which was the highest in 5 years. Whether these results are the result of past investments in technology and automation or more recent commitments to AI is unclear, but something's happening here. For starters, we can be more relaxed about the no hire, no fire labor market, as higher productivity gets us to the kind of corporate earnings and economic growth needed to support sky-high risk asset valuations. So productivity is fueling economic growth. Or is it something else? Also at work is something a bit more ominous: the draining of savings. The personal savings rate out of disposable income has dipped to 3.6%. That's the lowest in 3 years and well below the 20-year average of 6.1%. Now, you can make the case that a significant portion of U.S. individuals, the less wealthy, those that rent, own little to no stocks, those that are most vulnerable to the ravages of inflation and higher interest rates, and soon to be higher energy costs. It should come as no surprise that this group has dipped into savings in order to make ends meet, and that dipping into savings has helped to sustain economic growth. How big is that group? Well, Fed Governor Waller in a recent speech noted that the bottom 60% of households by income own just 15% of stocks, but account for 45% of spending. And by the way, some not insignificant percentage of that group has not only blown through savings, but has also tapped into, or worse yet, tapped out of borrowing capacity. Consumer borrowing sits at an all-time high. The aggregate level of consumer spending, that's 2.4% in Q4, that's the number that feeds into GDP, looks just fine. And with the employment rate sitting at 95.6%, this all holds together. But what if Governor Waller's characterization of the jobs market as, quote, weak and fragile, unquote, is correct? What if the labor market cracks beyond today's noisy print? What if the wealthiest, the top 20% that accounts for 35% of spending, pulls on the reins a touch in the face of a stock market correction? Economic output would fall, and with it, productivity. Food for thought. All right, on to our second thing: labor pessimism. Today's non-farm payrolls print will only add to the concern. Picking up on Governor Waller's description of the jobs market, weak and fragile, as mentioned above, we thought it would be timely to assess the state of the labor market in the U.S. Oh, wait, before we do, I just came across a piece in the New York Times with this carefully measured title: Mass Hysteria. Thousands of jobs lost. Just how bad is it going to get? Gives you a sense as to where we are. To be fair, this piece is meant to be a more balanced response to a certain fanciful tale published on Substack. You know what I'm talking about. That, in the words of the Times piece author, foretold of, quote, an economic hellscape that could result from AI-induced white-collar bloodbath, unquote. Yeesh, it might be helpful here to return to the data. Mr. Waller, oddly in a speech where he outlines that his greater concern regarding the Fed's two mandates had flipped away from the labor market to inflation, rests his weak and fragile labor market description on the fact that 2025 will likely be just the third year since 1945 that the economy lost jobs unrelated to a recession. We would pile on by adding that the vast majority of jobs created over the course of 2025 were in the lower paying healthcare and education sectors. It's not a pretty picture. But is it weak and fragile? Well, we're not so sure. As mentioned, 95.6% of the labor force is employed. The Fed's Beige Book out this week said employment across its districts was generally stable or flat, a continuation of the no hire, no fire environment that has been the case in the post-pandemic world. Worker availability was not at issue the way it was coming out of the pandemic. Labor participation has held in, especially among prime age workers, where the ratio sits at or near a 25-year high. The most recent ISM reports presented a mixed bag, with the services sector employment index showing expansion, while its manufacturing counterpart remained relatively weak despite an expansionary overall reading. On the small business front, 54% say they are hiring, according to the NFIB. It's up 4 points month on month. The One Big Beautiful Bill is creating CapEx incentives that are likely to create demand for labor, as will the commitment to reshore and or build capacity in strategically critical industries including defense, energy, technology, and pharmaceuticals. Call me a skeptic, but I just don't believe large organizations are culturally built to undergo transformational change quickly. That too will hold job levels. So weak and fragile? No, we don't see it that way. Some observers have described the market as stagnant. In places, yes, I'm looking at you, large organizations, but cutting-edge innovation and technology still happens here in the U.S. a lot. So I would not paint the entire labor market with that shade, just as I would not limit my analysis of the consumer to the aggregate data. As discussed above, I would not advocate limiting analysis of the labor market to just the hiring rate or the unemployment rate. All right, on to our third thing, inflation pressure. Well, this was not something the doves saw coming. On top of an historic stock market-driven wealth effect, unprecedented public and private infrastructure spend, the fallout from trade friction, 175 basis points of interest rate cuts, and sizable fiscal stimulus, you can now add the effects of an energy shock to the inflation risk story. Or can you? Economists dicker over whether an oil shock is truly inflationary. Is it a one-time price adjustment or not? All I know is that costs rise when supply is cut. Regardless, core PCE remains stubbornly above target as it has for 5 years, and we believe the economy figures to run hot at least through the first half of 2026 before the effects of tariffs and fiscal stimulus run down in the second half. Many FOMC members have come out with a more hawkish stance, most notably the aforementioned Governor Waller, whose flip to worrying more about the risk of inflation relative to employment risk is noteworthy, coming from a thought leader among thought leaders. Today's print might swing him back to worrying about the labor market once again, but I'm not so sure that will be the case throughout the FOMC. Now, war in the Middle East is a wild card. What cost pressures will be transitory and what will be passed through to other parts of the economy? Time will tell. The good news related to energy is that any production curtailment related to war is running into supply increase pressures that underpin markets heading into the disruption. In any event, upward pressure on prices will lean on economic growth and likely keep the Fed on hold until the second half of the year. It will also naturally create pressure on the appeal of fixed income. That said, whatever the pressure ends up being, it is likely to be more than offset by the income and diversification benefits offered by the fixed income asset class. Moreover, high-quality fixed income, i.e. investment-grade credit, figures to benefit as a haven asset. So there you have it. 3 things in credit. 1, productivity boom or savings drain. It's probably both that are contributing to growth. 2, labor pessimism. A closer look is not all that dire. And 3, inflation pressure. We expect it to rise in the first half and settle down in the second. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.